You're probably familiar with the ups and the downs of the stock market and understand how it could impact your retirement savings.
But what about your tax risk? Tax changes can impact your retirement as well.
Understanding the rising tax risk right now on Retiring Today. Welcome to Retiring Today. Today we're talking about the rising tax risk in your retirement. I'm here with Merkle. He's a certified financial fiduciary, a certified financial planner, and a retirement income certified professional. And Lauren, when we think about risk, I think it's pretty easy to say, yeah, the stock market. I know it's a risky or a riskier investment. So let's kind of set up the risk of the stock market. What is the risk when you choose to put some of your retirement savings into the stock market?
The risk of the stock market is that you could log on to your accounts one day and it could be 10% less than what it was a month ago. Or we go through a period of time that's really bad in the market and you log on and it's 30% less than what it was 6 months or even a year ago. So people are really familiar with this market risk. You invest in a stock, you invest in a bond, an ETF, a mutual fund, and you're hoping that over time it goes up, but there are going to be periods of time that you experience a loss, at least on paper, with those accounts. So that's market risk. It's going to either help grow your money or it's going to erode your money, but generally the direction should be trending up.
And it's an important piece of a retirement plan. When you put one together, you're definitely talking to people a lot about market risk. How do you feel about where your money is? How do you feel about if you lost X amount of percentage and how it would impact your retirement?
Yeah, people work really hard for their money. And so the idea of investing and taking some kind of risk with your investments is you want your money to work hard for you, because there's a time down the road that you don't want to have to work anymore and you're going to be dependent upon the income resources that you have, which are going to be this money that you've stockpiled away, and you don't want it just to kind of layer on top of each other. You want some growth from that money. So you're willing to take risk, so over time you can have more money than what you put into it as an original investment.
And I think a lot of advisors out there are probably talking to people about risk, maybe saying on a scale of 1 to 10, how much risk do you want to take? The thing that we want to focus on today, though, is the rising tax risks. So I think, and we're going to try to set this up, a lot of people would agree that the taxes are going up and that the risk or the possibility of this can really impact retirement.
Tax risk is really underrated when it comes to retirement planning. Everybody is fearful, or a lot of people are fearful of what the markets can do to their portfolio, because if you go through it like a 2008 type scenario, many people were down 40, 50, or even higher of a percentage in their portfolio. So that's scary for a lot of people. But if you do the right things when we go through those bad times in the market that we know are going to happen, on average we go through recessions every 6 years, so you know these things are going to take place. And as long as you hold through the portfolio, you're not going to cash or selling out those positions, eventually you're going to make that money back. When it comes to tax risk, if you owe 30% in taxes, if you pay 30% in taxes between the IRS and the state tax bill, you're not going to get that money back. And chances are you're going to pay 30% next year and then 30% next year, and that's assuming tax rates stay the same. Most people in today's environment feel like tax rates are probably going to increase before they stay the same or go down. So tax risk is the number one wealth eroding factor when it comes to people's retirement, because you can't just hold and hope it comes back. You're paying that money to these taxing authorities and you're not going to get it back.
And the reason taxes are such a big deal in retirement is because generally that's when you get hit with the big tax problem, because most of our money, most of Americans' money, they haven't paid taxes on yet.
Which is completely contrary to what we've always been told, because what we've always been told through the accumulation phase of our life is don't pay taxes on money now, defer those taxes, because later down the road when you retire, you're going to be in a lower tax bracket. Does that sound familiar? That's what we've been told throughout all of these years. For some people, that is true. Some people will be in a lower tax bracket when they retire, but for a lot of people, and a lot of the people that we work with, they are actually in the same tax bracket or higher because of what you just talked about. The vast majority of Americans' retirement savings is in dollars that have never been taxed. It's in your pre-tax IRA. It's in your pre-tax 401k plan. So when you retire, you're taking money out of those accounts, and you're going to have to pay taxes at your ordinary income tax bracket. And even if at retirement you don't need or want to take money out of those accounts to live on, At age 72 now, at required minimum distribution age, for most people at 72, you will be mandated to take distributions, pay taxes at your ordinary income level. And at that point in time, if you have a pension, you've already turned that pension on, and you have Social Security, most likely, you've already turned your Social Security payments on, and that's going to basically create a floor of a minimum tax bracket you're always going to be in unless tax rates go down. But again, most people think tax rates are on a one-way street and that street's going up.
And they do, and most people at home are probably nodding their head, but just in case you're not nodding your head, there are some I think just facts, some straight up facts that would tell us that tax rates may go up, and one of them is government spending.
Government spending we've never seen it at a higher level. Our annual deficit has never been higher. Our national debt has never been higher. Our debt to GDP, our gross domestic product ratio, has never been higher. And so all of those things come into play to indicate to us that tax rates are going to go up. So if we're thinking like the IRS, we're looking at the landscape. We know that there's 10,000 people retiring every single day. And that's going to happen for the next 10 to 15 years. And when those 10,000 people retire every single day, they're going to need to take income. Or even if at retirement they don't, at age 72 now they're going to be mandated. And most of that money that they're taking income from has never been taxed. So there's this whole pool of money that is just sitting there waiting to be taxed. And if the IRS needs to generate more revenue to help pay for all of this spending and the national debt that we have, one of the easiest ways is to increase the tax brackets. And then that money coming in, they're going to get a larger chunk, a larger piece of that money, which will go to the IRS coffers and help with the spending that we have right now.
I think it's also good to remind people that tax rates are at historic lows.
They are at historic lows. The lowest tax rate we have available to us today, besides 0%, is 10%. Prior to 2001, we had to go all the way back to the 1950s before we find another tax bracket that is as low as 10%. The highest tax bracket we have available to us today is 37%, which seems high. It seems high, it is high.
Yeah.
But historically speaking, it's actually really low. If we go back to 1980, we can replace that 37% tax bracket with 70%.
Wow.
And that is high, but it's still not the highest we've ever seen. What's the highest tax bracket we've ever seen? You know it's more than 70.
I just remember Ronald Reagan would only do one movie at the beginning of the year because all of the rest of his money went to taxes the rest of the year. So it had to be when Ronald Reagan was an actor. Yeah,
the story has it is that he made $100,000 per film.
Okay.
So what he would say, see, he'd only shoot 2 films a year, because after that, 94% of what he made went to the federal government right away.
So it was 94 the tax bracket?
94%.
Wow.
So that was just federal tax. That doesn't include state tax, property tax, sales tax, any of these other taxes we pay. So your point is, Molly, is that right now taxes are on sale. There's historical precedent for much higher taxes. We've never had a need for for higher taxes as what we have right now with the national deficit and debt. So tax rates are probably going to go up.
You might be wondering, how could taxes impact my retirement? Here's a great place to start. It's our tax analysis sheet. You can go to the website you see on your screen and fill out the tax analysis sheet today. We'll continue talking about the rising tax risk on Retiring Today.
When planning a big trip, do you like to look up points of interest, read restaurant reviews, or map out how to take the scenic route? You may spend days or even weeks getting ready for a week-long vacation. What about the 20 or 30-year journey that is retirement? Join us for a complimentary online workshop, Journey to Retirement, January 25th or 27th at 6:30 p.m. What you can learn from the comfort of your own home in these online workshops will help you plan for the most exciting journey of your life. Register today at merkleplan.com.
The Merkle Retirement Planning Team provides personable and professional expertise unrivaled in this area. They include us in every step of the planning process. The peace of mind provided to us by the Merkle team allows us to fully enjoy this special time of our lives. Instead of feeling snakebit, we feel confident that with the Merkle Retirement Planning Team at our sides, we can navigate any challenge that comes our way.
Merkle Retirement Planning. Your retirement starts here.
Welcome back to Retiring Today. We're talking about the rising tax risk in your retirement. I'm here with Lauren Merkle. And Lauren, let's get right to an example that I think really exemplifies how taxes can kind of punch your retirement like a gut punch.
Yeah, what we're going to show through this example is what I call your retirement tax bill. And this is a different way than most people think about the taxes that you're going to pay throughout the course of your retirement. This is a tax bill that you have to pay, but you don't have to pay all of it if you incorporate tax planning within your overall retirement plan. So we're going to show you what your retirement tax bill could be. We're going to show you what some strategies you can use to decrease that tax bill through this example. So let's get into it. What we're saying is you have a $500,000 IRA, and we have to use some assumptions. So some of the assumptions you can see on the screen. We're assuming a 5% growth between the age of 64 and 90. And then we're looking at distributions that you are taking from your IRA. So we're saying you don't even need this income from the IRA in your retirement. So at 72, when you're mandated to take required distributions from your IRA, you're taking it out, you're reinvesting it after you pay the tax. So you're not reinvesting it into another IRA because you can't. You're reinvesting it into something like a brokerage account. So when you take it out of the IRA, you're paying taxes on it, and we're assuming a 24% tax rate. You're reinvesting it, and then when you reinvest it, you will pay taxes every year on realized dividends, or on dividends that you receive, and realized capital gains. So that is in this equation as well. And then at the age of 90, when you pass away, you're going to pass on what's left over to your beneficiaries, and your beneficiaries then will have a tax bill on this as well. So if we add that up, the amount of tax you would pay between the ages of 64 to 90 on your distributions is a little over $200,000. The amount of tax that you will pay on the dividends and realized capital gains over the course of that time is just under $100,000. And then the amount of tax that your beneficiaries are going to pay when they inherit this money is roughly about $156,000. So add all of those three amounts up. That's a retirement tax bill of about $456,000, which, by the way, is also about the amount we started with.
It's almost about what the IRA value was at the time you started all this.
And that's not uncommon. When we do this type of analysis for people, whatever that account value starts out at, it's not uncommon for your retirement tax bill to be close to that amount, or about 2/3. So somewhere between 2/3 to 100% of the amount you actually start with. And very few people think about their tax liability potential in that way, because we don't monetize it, we don't add it up. We're just used to paying taxes. We know we have to take this money out. We've never paid taxes on this money before. So what can we do about it?
So somebody watching is probably like, my IRA isn't quite there. It's a different amount. I've got more, I've got less. There's a great way to kind of figure out what your tax bill looks like.
Yeah, and that's the analysis that we provide, is what is your potential retirement tax bill? And then what strategies can you implement to help decrease that tax bill over the course of your retirement? I can tell you, when we do this first part of the analysis, it is not uncommon for somebody to have a 7-figure retirement tax bill. But certainly, almost every time, it's at least 6 figures. So high 6 figures, in this case, mid 6 figures, but a 7-figure tax bill isn't uncommon. So now it's a matter of what can you do about it.
Okay, so if you're interested in a tax analysis, there's a website on your screen. You can go and check that out. And you know what this assumption doesn't do, Lauren? This assumption doesn't talk about if tax rates go up, if tax brackets change. This is using more like today's number, but we just set up, I thought, pretty well how it's a pretty high possibility that taxes can go up.
This scenario that we're using right here is just assuming a level tax rates from age 64 all the way to age 90. Most likely, we're not going to live through that type of scenario. So the retirement tax bill that you would experience in this scenario, if this looks like you, is probably going to be more significant than what we're showing right here.
Yeah, and as we continue our tax conversation, let's talk a little bit about how taxes change, because I think when we think about how taxes can change, it's real obvious. We know brackets can change, right? Percentages on the brackets can change, but there's a couple of other ways that the government can kind of change how much money they collect from citizens.
Another way that the amount of tax you pay could change is based on deductions. So right now, everybody has a standard deduction, and roughly about 90% of us use the standard deduction as opposed to itemizing your individual deductions. So that standard deduction could change, or if you itemize, the the expenses that you currently itemize, that could change, and some of those could be eliminated, and that's another form of increasing taxes. If your standard deduction goes down, or if they eliminate some of these otherwise itemized expenses, that's going to have an impact on the overall tax bill that you pay as well.
And what type of new taxes could the IRS put in place?
One of the most common ones that we think about is taxing Social Security. So as an example, right now in the state of Iowa, your Social Security income is not subject to income tax in this state. That could change. On a federal level, Social Security income is what I call tax favored, which means you're not paying federal tax on 100% of your Social Security income. In fact, some of you are paying no federal tax on your income from Social Security. It's somewhere between 0 to 85% of your Social Security that you're paying tax on, and it's all dependent upon what your taxable income is.
Okay, so $456,000 in taxes on a $500,000 A. I'm coming into you and I'm saying, Lauren, I don't like it. There is something I can do, right?
There certainly is a solution. Actually, there's multiple solutions, but we're going to focus on, in this scenario, one of the common solutions and most powerful solutions that could really impact your retirement tax bill.
Okay, we'll walk you through that solution when Retiring Today continues.
When planning a big trip, do you like to look up points of interest, read restaurant reviews, or map out how to take the scenic route? You may spend days or even weeks getting ready for a week-long vacation. What about the 20 or 30-year journey that is retirement? Join us for a complimentary online workshop, Journey to Retirement, January 25th or 27th at 6:30 p.m. What you can learn from the comfort of your own home in these online workshops will help you plan for the most exciting journey of your life. Register today at merkleplan.com.
Anytime I have even the smallest question about my accounts or what effect the latest tax law might have on my situation, the Merkle Retirement Planning Team is always there and quick to help. I'm so glad they treat you like family. I'm so happy to have such an excellent team working for my future and ensuring I do the best to achieve my financial goals.
Merkle Retirement Planning. Your retirement starts here.
Welcome back to Retiring Today. I'm here with Lauren Merkle. And Lauren, before the break, you promised us a solution. I know you're a man who delivers on his promises. Show us something.
All right, let's deliver on the promise. What we're talking about here is just one solution. Again, there could be many. We're just simplifying it for today. And we're going to say that the only solution you employ in this strategy is a Roth conversion. So what that means is you're taking pre-tax money from your IRA that you've never paid taxes on before, you're paying taxes on it, you're actually making a decision to pay taxes on it prior to having to pay tax on this money. You're going to shift it over to the Roth IRA. Once it's in the Roth IRA, it grows tax-free forever. So the idea is later down the road, you're going to use money from your Roth IRA, tax-free, and whatever you don't use, it's going to go on to your kids, your grandkids, your beneficiaries, and they will not have to pay taxes on it either. So once it's in the Roth, it is insulated from any future tax hikes, and nobody's going to have to pay taxes on the earnings. That's what we're saying here. And all we're saying is you take the $500,000 IRA and you convert it, you pay 25% on it, which means you will pay a retirement tax bill of $125,000. But that $125,000 tax bill pales in comparison to the tax bill that you would have paid if you just waited till your RMD age and started taking it out, reinvesting, paying taxes on the capital gains, the dividends, and then you having your beneficiaries pay taxes on the amount they inherit. Significant difference. And again, that's just a basic Roth conversion strategy. And that's not saying that you converted all the $500,000 at one time. What that strategy is we call it fill up your tax bracket. So if you're in the 25% federal tax bracket, then we will convert incrementally over time to fill up that 25% bracket. So in this example, you're just paying 25% across the board, $125,000 total on that federal tax, which is significant difference on your total retirement tax bill versus just waiting and hoping it works out.
And what I like in this example on the screen is the zeros, right? So you're not going to pay on the growth as you would have in the prior example. Your beneficiaries are not going to pay taxes, and that 125 is one time. But let's go back to that 125 because that is a lot of money. It's the money you pay in the year that you do the conversion, and doesn't always make sense for everybody to do the Roth conversion.
Roth conversions don't make sense for everybody in every year. A Roth conversion may make perfect sense for you this year, but it may not next year. And it may not make sense next year, but it might make sense the year after that. That's why this is an evaluation every single year. We have to go through the appropriate analysis to identify, does 25% tax bill make sense for you? Is that a good deal for you? For some people, it's a steal. Right? People would be really happy to pay 25% because of what they would pay if they didn't pay 25%, as in this example. You would much rather pay $125,000 of total tax bill than $456,000. But for some people, 25% is not a good deal, so you have to identify, is that a good deal for you, whatever that tax bill of yours is, and can you have a better deal down the road if you implement a different strategy? So that's all a part of the analysis. What would you pay now if you do this? What would you pay later if you did this? And then once you have that information, these decisions become very simple. They become very easy. And that's part of the benefit of having your written retirement plan that involves a written tax plan. Because it's one thing for me to sit here and say, yes, Molly, this is a great idea. You should do that this year. It's another thing for you to see it and to see why, and to see if you do it this year, if you convert this much this year, here's the impact it makes on you short term, and then here's the impact that it has on you long term. And then once you see that information, you can make that decision, whatever decision is most appropriate for you. You can make that decision with confidence and not have to look back and say, I wish I would have done something different.
Does whether you're using the RMDs to reinvest or for your living expenses, does that make a difference in this whole conversation as well? Because that first example, they were reinvesting the RMDs. Some people probably use them for living expenses, pay the mortgage, transportation, things like that.
Yes, and if we use this same example, so let's say you were not reinvesting your required minimum distributions, you were taking it out to live on it. Well, in essence, what that would do is it would decrease about $96,000 off the retirement tax bill. Because in this example, we had you reinvesting them, then you're paying taxes on the dividends and capital gains, that growth. So that would eliminate about $100,000 off the retirement tax bill if you used it for lifestyle as opposed to reinvesting it.
And strategies like this are just one piece of many that go into retirement planning.
It certainly is, and part of this strategy right here is what should you be doing? What kind of strategies should you be incorporating? Well, we can't just take the tax plan and silo it out and say this is what you should be doing from a tax plan without looking at the other components of your overall retirement plan. Because what you do with the tax plan will impact what your income plan looks like. And what you decide from an income planning standpoint can impact what you're going to do from a tax planning standpoint. As an example, again, your Social Security income is what we call tax favored. So in order to give you some additional Roth conversion room, do we want to take your Social Security income because it's tax favored as opposed to living on income from your IRAs? Or do you have some cash sitting on the sidelines making almost nothing? Can you live on that cash and give you a whole lot more room for these Roth conversions and other tax strategies? So you can see how the income plan and the tax plan are integrated in a very definite way. But the income plan and the tax plan is also integrated with your legacy plan. And that's part of what this example demonstrated as well, is what you decide to do tax-wise and income-wise will determine how much you have left over, and then whatever is left over, how it goes to the kids and beneficiaries, what their tax liabilities are, what their ability to use that money is as well. So all of these components of the plan are integrated together, and we can't just take one piece of it without taking everything else into consideration. Otherwise, you could end up with a mess of a plan and a disorganized plan as well.
Yeah, and I suppose, Lauren, there's some people watching going, I don't know what I want to do with my legacy. I'm not quite sure if I want to take Social Security yet. Do I need long-term care insurance? A great place to talk about all of these things are our Journey to Retirement workshops.
In our Journey to Retirement workshop, it's all about your journey. And we specifically use a couple, John and Sue, and we talk about what goals they have throughout the course of their retirement, and then specific strategies they can use to incorporate or accomplish those goals. And so we basically unveil what their retirement plan is, the different components of the plan, all the way from the income piece, what income strategies are they using, what tax mitigation strategies are they using to help increase their spendable income, decrease their tax bill? What are they going to do from a long-term care standpoint? Everybody has long-term care risk. What if, when you're 80 years old, you need an extra $15,000 a month just for long-term care? Can you afford that type of care? And maybe more importantly, what does that do to your surviving spouse the rest of his or her retirement? And then the legacy piece of it. So we walk everybody through what their plan is, specific actionable steps that they can take. And that's really our hope, is you can take some steps out of that Journey to Retirement workshop, implement them in a very nice, succinct way for you to help you live your best retirement vision.
For information on the Journey to Retirement workshop, go to the website that's on your screen right now. We talk about the 6 guiding principles of retirement at length in that workshop, and you'll sure learn a lot. People walk out of that workshop. Lauren, what do they say to you?
Well, the biggest feedback that I get is, I wish I would have. I wish I would have known that 5 years ago. And that's really what the retirement plan, the written comprehensive retirement plan, is trying to avoid. Is you want to make decisions, with confidence and not have to regret decisions you make, and not have to have that feeling of, did I make the right decision? Should I have made a better decision? When you can see it, and you can see the potential outcome of your decision in writing, it's a lot easier to make those decisions.
Yeah, and of course this is an exciting time for people, but kind of a scary time. What a nice thing to do, to be able to take some of the anxiety away and say, hey, here's your plan. Take it into the sunset. One
of my favorite parts of what we do is when we're sitting across the table from a family and we showed them their retirement plan. This is what their retirement from a financial standpoint looks like. You can a lot of times just sense that anxiety kind of washing away, because they can see it. And they can see how they're going to be able to afford this time frame that they've always dreamed about. When now they have all this free time, they want to spend it with grandkids or their kids or travel, all these different things. They can see how they can accomplish it. It's a lot of fun.
And we'll continue talking about how to accomplish your retirement vision on this show. It's Retiring Today, and we thank you for watching.
When planning a big trip, do you like to look up points of interest, read restaurant reviews, or map out how to take the scenic route? You may spend days or even weeks getting ready for a week-long vacation. What about the 20 or 30-year journey that is retirement? Join us for a complimentary online workshop, Journey to Retirement, January 25th or 27th at 6:30 p.m. What you can learn from the comfort of your own home in these online workshops will help you plan for the most exciting journey of your life. Register today at merkleplan.com.
The Merkle Retirement Planning Team provides personable and professional expertise unrivaled in this area. They include us in every step of the planning process. The peace of mind provided to us by the Merkle team allows us to fully enjoy this special time of our lives. Instead of feeling snakebit, we feel confident that with the Merkle Retirement Planning Team at our sides, we can navigate any challenge that comes our way.
Merkle Retirement Planning. Your retirement starts here.
Thank you so much for watching Retiring Today. We hope you've enjoyed the show.
See you next week.